Federal prepares for change in policy and in policymakers. NYTimes.com. Subscribe. Digital/home delivery. Log in. Register now. Help. Homepage. Today's paper. Video. Most popular. Edition. US/global. Search all NYTimes.com. Economy. World. US. NY/region. Business. Technology. Science. Health. Sports. Opinion. Arts. Style. Travel. Jobs. Real estate. Autos. Global. Deal book. Markets. Economy. Energy. Media. Technology. Personal tech. Small business. Your money. Federal prepares for change in policy and in policymakers. Michael Reynolds/European Press Photo Agency. A meeting of the Federal Reserve's Board of Governors in July. The group could have 9 new voting members over the next year. By BINYAM by N. Applebaum. Published, September 12, 2013. Washington. Federal Reserve officials, who have made clear that they intend to cut back on the Fed's monthly asset purchases by the end of the year, must decide next week whether it is time to tap the brakes or better to wait another month or two. Multimedia. Graphic. The group in flux. Multimedia feature. The taper tracker. The far-thornier challenge they face is convincing markets that the Federal remains committed to its broader effort to stimulate the economy even as it begins to pull back from the most visible component of that campaign, and even though as many as 9 of the 12 voting members of the Fed's policy-making committee may be replaced in the next year. Most notably, Ben S. Bernanke, the Fed's chairman, is expected to step down at the end of January. The person President Obama is widely expected to nominate in his place, Lawrence H. Summers, has said little about monetary policy in recent years. Federal officials are concerned that the markets will misinterpret the introduction of tapering, as the impending move is popularly known, as a sign of a broader retreat. They are expected to discuss ways of reinforcing the Fed's continuing determination to encourage economic activity and job creation when the Federal Open Market Committee meets here Tuesday and Wednesday. The overwhelming incentive at this meeting is to dull the hawkish effects of tapering with more dovish communication, wrote Eric Green, head of rates, foreign exchange and commodities research at TD Securities. The Fed's message, he said, has been ill-defined and not internally consistent. The good news is that the FOMC has the opportunity to improve on that message. The Federal under Mr. Bernanke has struggled for much of the last 5 years to find new ways of stimulating the economy beyond its baseline commitment since December 2008 to hold short-term interest rates near zero. Last year, officials announced an aggressive combination of asset purchases and forward guidance, both tied to improvement in the labor market. The Federal said it would buy $85 billion a month in Treasury securities and mortgage-backed securities to jumpstart job growth, and keep short-term rates near zero at least as long as the unemployment rate was above 6.5%. It was 7.3% in August. In June, however, Mr. Bernanke surprised many investors by announcing that the Federal intended to reduce the volume of monthly purchases by the end of the year, and to end the purchases entirely by the middle of next year. An official account of the committee's most recent meeting in July affirmed that almost all participants favored Mr. Bernanke's timetable, provided that economic conditions improved broadly as expected. Investors have started to demand higher interest rates, driving up borrowing costs, and critics warn the Federal is pulling back too soon. The unemployment rate is down from 8.1% in August 2012, just before the Federal started the expansion of its bond portfolio. But roughly half the decline happened because more adults were not even trying to find jobs. The share of adults with jobs, down sharply during the recession, has yet to recover any of its losses. Federal officials have emphasized in response that their policy decisions are forward-looking. Changes in monetary policy seep slowly through the economy, from the Federal through the banks into the decision-making of business and individual borrowers, and Federal officials have said they are convinced the economy will not need as much help in the next few years. Mr. Bernanke and his allies also face mounting pressure from internal critics who worry the modest benefits of asset purchases increasingly are outweighed by the risk that continued expansion of the Fed's holdings will disrupt financial markets, by encouraging speculation, by limiting the